Welcome back to Market on Close. I'm Marley Caden. Joining me now here in studio is Zed Francis, the CIO of Convexitas. Zed, thanks for being in studio with us this afternoon.
Wonderful to meet you in person.
Yes, it's so great to have you here. Now, I guess let's just start with the change that we're seeing this week versus trading Friday and even trading yesterday.
Yeah, I mean, it's really actually pretty impressive how different Friday and today was. And Friday, in theory, was the surprise. Like, it should be a little bit old news, although escalating by the time we got to today. But Friday was not your traditional risk-off trade. S&P was down more than it is today, but implied volatility was barely up. You had interest rates actually rally, sell off versus rallying today. So not what you'd expect. And even like your ancillary things like, the cryptocurrencies and things like that had a much less dramatic move on Friday relative to today. Today's looking much more like traditional risk off. And the move in volatility today in the S&P 500 is actually pretty significant.
So you mentioned that we've had some market behavior, particularly in rates, that is out of character. With that, and we've been seeing it a lot more, do you think that rates are still a flight to safety asset, or are we moving away from that traditionally accepted view?
I think the issue with rates being a flight to safety asset is, one, it hasn't worked in a while, right? So it's hard to have that gut shot reaction when you haven't been rewarded for it for now a handful of years. I mean, frankly, even during the tariff tantrum, the second week of that, which was the meat of it, interest rates were hurting your portfolio again. So it's been a while since you've been rewarded doing that rotation from risk assets into treasuries during these times of crisis. Obviously, again, we now have a little bit of a different, we'll call it fundamental situation. We all know the fiscal story. We all know current, debt to GDP, all the not wonderful things from a fundamental standpoint. So we might be truly in a different regime for a longer period of time than just the last 4.5 years that we've experienced. But it definitely is showing you what you need in your portfolio to support these types of events might not be what worked really well the last 40 years.
So I want to get your thoughts on a comment. Scott Bessent said that there is nothing systemic about what's going on in the bond market. And, quote, I think it's an uncomfortable but normal deleveraging that's going on. Thoughts on that now that it's still going on?
Yeah, I mean, I think the main problem is there's like two bond markets, right? Mm-hmm. It's the front end and everything else. Yeah. And I think the front end is like truly 18 months in, like front end. And we have plenty of sources of means of stopping that the supply up on the extreme front end. But anything beyond that, there's kind of not a natural home. Your longer dated treasuries used to be sovereigns, and ultimately I think a lot of our sovereign friends are potentially not looking to continue to load up on longer duration U.S. paper. And it has been the case, for the last, frankly, kind of like almost 10 years, they've been lightening up on longer duration paper. You had, we'll call it, corporate pensions, a little bit of public pensions and insurance. They've already done their de-risking. That already kind of took place when we went from 0 to 5%. So they're already full. They're not necessarily in need of excess duration anymore. So it's like, where are we going to find that home for 5+ year paper? And over the last 3-4 years, it's actually been the wealth channel. It's been you and me saying, hey, we got really accustomed to close to zero rates. Now we're seeing things with a 4 handle that feels like a big improvement, a big difference. But I think we've kind of made it through a couple tax seasons, which everybody says, man, geez, like that 4% is really 2.5 after tax. Is that something I really want in my portfolio, especially if it's not acting like a ballast?
Well, it's amazing, too, when you mentioned that it feels so much better than when it was, high. We were up in 6. It's like, 4 feels great. Now, I'm just pulling up. Jamie Dimon said today that the bond market is going to crack, and you're going to panic when it does, because we've seen so many market vigilantes are out in force right now. Do you think it's going to crack?
So my gut would be that we haven't seen the highs or longer end interest rates. Again, it's much easier to control the front end. And I think tomorrow we're actually going to see some of that, not necessarily the FOMC trying to control interest rates, but I think their tune is going to change a little bit tomorrow. And I'm very intrigued what the longer end does. And what I mean by that is I actually think they're going to come out and be pretty dovish relative to expectations tomorrow. I wouldn't be surprised if we start seeing the front end pricing in additional cuts after the meeting tomorrow. I don't think they're going to do any action tomorrow, but I think it's going to be a very soft, dovish tone as they kind of pull back their impacts of potential inflation effects of the tariffs are a little bit less than they thought. They're seeing a little bit more of a slowdown in growth. They're seeing a little bit more of a slowdown in the consumer. And I think they're going to communicate, we're probably getting closer to resuming a rate cutting cycle. But I'm very, very intrigued. We'll call it a week from now. The gut reaction, you know exactly if that's the right indicator. But a week from now, if 10s are going to be higher or lower in terms of yields off of a dovish statement, I think it's going to tell you a lot about investors' appetite to hold longer duration assets in a potentially easing cycle.
Absolutely. And how many cuts are you thinking we'll see this year?
I think we're going to probably shake out to 3. But it's
3? That's the highest I've heard.
Yeah, but I think that's probably where we're going to end up. And I think the statement tomorrow is going to reflect something closer to those lines. I think ultimately they want to get back down to something what they proclaim neutral, and I think their new neutral is going to be right around that 3-ish% zone. So I would not be surprised if that's where they're going to try to guide us tomorrow to where they're going to be in December.
And we didn't see too much discussion about more dovish viewpoints and more dovish language really until this morning when the weaker retail sales came out. Do you think that will be a partial driver into that push away from that sort of general neutrality that we've seen?
I think their big problem is everybody has the inclination that inflation is going to increase in the upcoming months, but the data that we've received over the last, kind of 3-ish, 4-ish months has been going the correct direction in terms of reducing inflation and the ability to cut rates further. And if they're going to remain in a data-dependent style stance and actually have people listen to their message going forward, they kind of have to start following the data at some point in time. They can't say, none of this is meaningful until August and keep kicking the can. So I wouldn't not be surprised if tomorrow comes off as shockingly dovish and changing the direction a little bit.
Yeah, and it makes perfect sense. Although you have the converse where everyone says we have to wait till August to see the tariff impact because we don't know. Do you think those concerns are warranted that we could potentially see some reinflationary issues with these tariffs and passing down the cost to consumers?
Yeah, no, we definitely have a lot of things in the pipeline that can definitely increase inflation going forward. And obviously right now energy prices are highly reactive, that we can see it quite quickly. But again, in theory, they're supposed to ignore energy prices. So what we're seeing right now is going to pop up headline CPI most likely in coming months. But in theory, their PCE metrics shouldn't be overly affected by it. So you got these kind of cross streams of what they've told us for a bunch of years, the data within the inflation prints that they care about versus not. And housing has finally started to ease, which is an important one and what they actually care about. So I would not be surprised if they're almost going to set the table for, we might get a little pickup by 1/10, 2/10 upcoming months, but that's back to the transitory style of inflation in those data points.
That one phrase that will never go away, transitory inflation. Now, I want to make sure we get to everything because we were talking off camera about the tariff tantrum and how we both love that phrase, and volatility, as it pertains to volatility and the V-shaped moves that we're seeing. Give us some observations about, general market moves and volatility.
Yeah, it's been pretty amazing over the last year plus, not only the move in equity prices down and immediately recovering, but also the quote-unquote second derivative, whether you're looking at credit, whether you're looking at implied volatility, or even the quote-unquote third derivative, volatility of volatility. Those things are correcting even faster. So if you look back to the tariff tantrum of April, you had volatility collapse back to March levels, and options on the VIX go all the way back to those March levels when we were still 12% off, all-time highs. The second derivative risk, which it historically takes a little bit longer to get stripped out of the machinery of the market, is reacting the most quickly. And so I find that incredibly interesting that essentially the market not only is saying that the risk that we just experienced is now no longer there, that we're completely removing the potential of that experience creating more risk into the near future. It just gets wiped out incredibly fast. So it's a very funky market over the last 12, 18 months, how quickly we get the risk on event and instantly risk off.
We've seen so many V-shaped moves. It's funny you're talking about vol of vol. We've got Kevin Green coming up with options after this, and I'm sure that we will talk about it. But Zed, I want to say thank you for joining us in studio today. Again, that's Zed Francis with Convexitas.